Insurance exam prep regulation and oversight of insurance. Question 1. The primary source of insurance regulation is at the federal level, state level, municipal level, international level. Insurance is primarily regulated at the state level by the state's Department of Insurance. Question 2. Which federal act gave states the authority to regulate insurance? McCarran-Ferguson Act, Fair Credit Reporting Act, Patriot Act, ERISA. The McCarran-Ferguson Act of 1945 established that state regulation of insurance is in the public interest. Question 3. A company incorporated in the state where it does business is a domestic insurer, foreign insurer, alien insurer, mutual insurer. A domestic insurer operates in the state where it was incorporated. Question 4. A company formed under the laws of Canada but operating in Texas is an alien insurer, foreign insurer, admitted insurer, unauthorized insurer. Alien insurers are incorporated outside the United States. Question 5. Which entity protects policy owners if an insurance company becomes insolvent? The NAIC, the Federal Reserve, State Guarantee Association, Department of Insurance. State guarantee associations step in to cover claims when an admitted insurer goes bankrupt. Question 6. Offering a client part of the commission as an inducement to buy is called twisting, rebating, coercion, redlining. Rebating is the illegal practice of offering an unauthorized financial inducement to a prospect. Question 7. Persuading a client to cancel a policy to buy a new one to their detriment is twisting, churning, rebating, defamation. Twisting involves misrepresentation to induce a policyholder to lapse, forfeit, or surrender a policy. Question 8. Under the FCRA, what must happen if an applicant is denied coverage based on a credit report? They get a free policy. They must be notified and given the agency name. They cannot reapply for 5 years. The agent loses their license. The Fair Credit Reporting Act requires applicants to be notified and provided the reporting agency's contact info. Question 9. Which organization creates model insurance laws for states to adopt? FEMA, NAIC, SEC, FINRA. The National Association of Insurance Commissioners, NAIC, drafts model laws for state consideration. Question 10. Making maliciously critical statements about an insurer's financial condition is twisting, defamation, coercion, boycott. Defamation is the illegal practice of making false, maliciously critical statements about an insurer. Question 11. An insurer authorized to do business in a state is called an admitted insurer, alien insurer, non-admitted insurer, surplus lines insurer. An admitted or authorized insurer has received a certificate of authority from the state. Question 12. Charging different premiums for individuals of the same risk classes, unfair discrimination, underwriting, redlining, adverse selection. Unfair discrimination is charging different rates for people of the same class and life expectancy. Question 13. The purpose of the USA Patriot Act in insurance is to regulate commissions, prevent money laundering, protect consumer privacy, guarantee solvency. The USA Patriot Act requires insurers to implement anti-money laundering (AML) programs. Question 14. Refusing coverage strictly based on geographic location is known as twisting, redlining, rebating, defamation. Redlining is the illegal practice of denying coverage based solely on the geographic location of the risk. Question 15. Who appoints the Commissioner/Director of Insurance in most states? The NAIC, the state governor, the president, the voting public. In many states, the governor appoints the commissioner, though in some they are elected. Question 16. Which of the following requires a certificate of authority? An agent, an admitted insurer, a surplus lines broker, a non-admitted insurer. Insurers must have a certificate of authority to be admitted to operate in a state. Question 17. If an agent handles premium funds improperly, they violate their fiduciary duty, implied authority, express authority, underwriting rules. Agents hold premium funds in a fiduciary trust capacity and must strictly account for them. Question 18. What penalty can the commissioner impose for an unfair trade practice? Jail time, fines and license suspension, deportation, federal prosecution. Commissioners can issue cease and desist orders, levy fines, and suspend or revoke licenses. Question 19. A temporary license is usually issued for 6 months, 180 days to 1 year, 5 years, 10 years. Temporary licenses, often for surviving spouses or designees, typically last up to 180 days. Question 20. How often must an insurance producer typically complete continuing education? Every 6 months, every year, every 2 years, never. Most states require producers to complete CE credits every 2 years to maintain their license.